Welcome back everyone. I hope you're doing well, and in this video, we're going to take a look at 5 dividend paying companies that you can own for growing passive income every single year, and these companies pay out some of the safest dividends on the market right now. All the companies in today's video pay out a very safe dividend that is likely to grow every single year for decades to come. These companies have very well established operations with very strong points of difference, brand loyalty, and have very strong future projections. So for each of the 5 stocks, we're going to take a look at the company's current financial position, their operations, and their current dividend scorecard. And before we take a look at company number 1, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button and subscribe for the daily videos. And the first company that pays out a very safe dividend that grows each and every year that you can collect for some pure passive income is ticker PG, Procter Gamble. They currently trade for $137 per share, and over the last 12 months, the company has grown by over 21% with a current market cap of $336 billion and a dividend yield of 2.3%. This is one of the largest consumer companies in the world. They sell their products in over 130 countries, and they've been operational for over 100 years. This company is the definition of long-term success, and I think they will continue to grow for decades to come because of how well their products are already established at scale, the brands are loved, and going forward, I don't really see any other consumer company knocking out PG from their market leadership position. And we can see that this company has a massive suite of different products and brands all under the Procter Gamble umbrella. And they sell consumer products in 10 different categories, which include baby, family, fabric, home, and many more. And with their brands, they sell necessities, the products that you're going to need every day or every week in your home, regardless of the economic situation. So through good times or bad times, people are still going to shop for Procter & Gamble products, which has shown over the long term why this company has been so successful. And we can see some of their main products include Tide, Bounty, Pampers, and many more. And over the past year, 9 of their 10 consumer categories posted very fast sales growth of at least 6%. And in the first half of the fiscal year 2021, their home care grew 32% overall as consumers are really picking up the cleanliness of their home care products. And we can see overall, it doesn't matter which category you're looking at, it's all posting growth, which is extremely impressive. And Procter & Gamble has returned a growing dividend to their investors for 64 consecutive years, which is absolutely insane. And over the last 130 years, they have been paying out a dividend. So 130 years of paying out a cash dividend to their investors is absolutely incredible. And over the last decade alone, they have returned $135 billion of capital to their shareholders through share buybacks and a dividend payment. And their dividend still is growing at a decent rate year over year, from $1.80 back in 2010 to all the way up to $3.03 in the fiscal year of 2020. So this company has been one of the most well-known, strongest dividend-paying companies on the market, and even after such a long dividend history, they are still considered one of the safest income-producing stocks available to buy right now. And if we jump over to their income statement, every single year, even for this giant, they continue to expand their total top line, generating close to $74 billion of total sales in the last 12 months. And if we take a look at their dividend scorecard, a yield of 2.3% only makes up 55% of their total net income, and that annual payment is growing at an average of 3.6% every single year. So your annual dividend increase is actually surpassing inflation over the long term. And this company has the highest dividend safety score possible, coming in at a 99. So this is a score that's generated from the platform Simply Safe Dividends, and they rank every dividend paying company in terms of their dividend safety from 1 to 99, with 99 being the highest and the safest score possible. So all of the companies in today's video are coming in with this 99 score, meaning it's extremely unlikely that we see a dividend cut coming anytime soon. And how the platform comes up with this number is by taking a look at many different financial metrics. They have this algorithm, and then it spits out a one simple and easy to read number that we see here with a 99. And with Procter Gamble, the beta is considered low at 0.62, so you can own this company, not have a lot of share price volatility, and collect that passive income that grows every single year. So PG is definitely a staple of many dividend investors' portfolios. It's one of the best companies on the market you can buy right now for some safe and growing passive income. And now we're going to move on to the second stock that pays out a very safe dividend, and that is ticker J&J, which is Johnson & Johnson. The company currently trades for $163 per share, and over the latest 12 months, this healthcare giant is up just around 19%. They have a current market cap of $43 billion and are trading with a very reasonable forward PE of only 17.2 and a dividend yield at 2.5%. And over the latest 12 months, this company has generated over $82 billion of total sales in three main product categories, which are consumer health products, and they own the brands like Tylenol, Listerine, Band-Aid, and many more. They also have a massive big pharma sale category where they generated $45 billion, and they also have $23 billion of sales from the medical devices. And this company has a massive suite of products and owns 28 different platforms/products with over $1 billion in annual sales. And that's just absolutely incredible. That just shows the company in total generated $82 billion. 28 different products or brands each generated over $1 billion. Meaning this company is not solely reliant on one or two big names to drive the entire company's growth. So if one or two platforms ends up going down, the company's not going to be hurt that bad because of how well and diversified the entire company is. And they own 12 different products that have generated over $2 billion in annual sales, which is extremely impressive. And going forward, they're projecting between 8 and 9.5% annual sales growth for a big company. That's extremely impressive. And their adjusted earnings per share over the next 12 months is forecasted to grow between 17 and 19%, which would be absolutely incredible. And if we jump over to their income statement, over the past 5 years, this company has been absolutely incredible, continuing to expand at a decent rate year over year with over $82.5 billion of total sales in the trailing 12 months. And taking a look at their dividend, a yield of 2.5% only makes up 42% of their net income, so very safe, extremely sustainable, and can continue to grow at a decent rate over the long term. And over the past 5 years, their annual dividend growth rate is 6.13%, and their dividend growth streak is now at 58 consecutive years, making this one of the longest active dividend kings available to buy on the market. And like we mentioned before, all the companies in this episode have the highest dividend safety score, coming in with a 99, so it's extremely unlikely that we see a dividend cut to come from Johnson & Johnson anytime soon, and definitely another big healthcare giant to take a look at for your own personal dividend portfolios. And now on to stock number 3, we have ticker NEE, which is Nextera Energy. They currently trade for $77 per share, and over the latest 12 months, the company has grown by 35%. They have a current market cap of $152 billion with a dividend yield of 2%. And this is one of the larger utility and energy companies operating within the United States. And they have operations in both the traditional sector and the renewable sector as well. So going forward, as the government continues to offer incentives for renewable-based companies, I think Nextera is only going to grow for long into the future. They currently have $128 billion of total assets and are the world leader in electricity generated from the wind and sun. And we can see that over the long term, they have posted some incredible performance. Since 2005, their adjusted earnings per share has grown at a CAGR of 8.7%, which is huge for the utility/energy sector. And their annual dividend from 2005 to today is growing at a CAGR of 9.6%, so once again, extremely impressive. And their total shareholder return over the past 10 years is at around 700% compared to the S&P 500, which has returned only 267%. So they've more than doubled the performance of the overall market, and this is a big name company with no signs of slowing down in their operational growth anytime soon. And if we take a look at that dividend, the yield of 2% only makes up 61% of their total net income, and over the past 5 years, they're growing their annual dividend at over 12% annually. And this is a dividend aristocrat with a 26-year streak of consecutive dividend growth. And of course, they do have the 99 dividend safety score, meaning extremely unlikely that we see Nextera to cut their dividend anytime soon. So this is a player that I own in my personal portfolio as well. I like the exposure to the renewable space, and they have such strong operations that over the longer term, just through inflation and annual increase in their prices, this company will continue to grow and expand at a decent rate. And now we're going to take a look at the fourth company included in this episode that pays the highest dividend safety score possible, and that is ticker MRK, which is Merck & Co. The company currently trades for $75 per share, and over the latest 12 months, they are actually down in the red by 3%. They have a current market cap at $191 billion and trading with a very low and affordable forward PE of only 11.7. And they are one of the higher yielders in today's video with a current dividend yield of 3.4%. And this is a company I've been adding to my position to in my personal portfolio as well. And I think Merck at this current level is getting very attractive. And we can see over the fourth quarter of 2020, their worldwide sales did still grow by 5% even throughout the pandemic, and their earnings per share grew 17% overall. So they're continuing to grow and continuing to return capital to their investors. In the latest quarter, they returned $1.5 billion out to their shareholders through the form of a dividend, and they also invested $2.6 billion in research and development to continue to expand their operations over the longer term. And we can see that over the past 4 years, all of Merck's main products and categories have been growing at a terrific rate. And in 2020, Keytruda grew 30% year over year. They saw 62% growth, 43%, their animal health improved 10%, and overall, all 6 of their main categories and products continuing to grow annually, which is a great sign. And they also gave out guidance for the full 2021 fiscal year, where they're projecting revenue growth between 8 to 12% and a non-GAAP gross margin of 77% overall. And that's just absolutely incredible. For a company like this, at their scale, to continue to grow revenue in the double digits, that'd be absolutely impressive. And right now, their non-GAAP earnings per share is forecasted to grow by 12 to 15%, which once again, is a very strong future projection. And if we take a look at their dividend information, they have a nice 3.4% current yield, they only pay out around 40% of their total net income, and their 5-year annual dividend growth rate is at 6.2%, which is fantastic. And like all the others, they have a 99 dividend safety score, so very unlikely that we see a dividend cut to come from Merck anytime soon. So this is definitely a company to take a look at for your portfolio if you want some nice high passive income from the big pharma space. And now we're going to move on to the fifth and final company included in this episode, and that is ticker AFL or Aflac Incorporated. The big insurance company currently trades for $51 per share, and over the last 12 months, they have climbed by close to 45% and now trade with a current market cap of $35 billion and a very low forward PE of only 10.6. So at this current level, with a 2.5% dividend yield, you're getting a ton of value from Aflac Insurance. And although they are known very well within the United States market, this company actually generates a majority of the revenue overseas, and a lot of the revenue actually comes from Japan. And they're the number one provider of cancer and medical insurance in the country of Japan, which is absolutely incredible. So they are not solely focused on the United States economy in order to grow. And the Japanese market is projected to double over the next 10 years, and we can see their 3 largest products include cancer, medical, and life insurance in that big Japan market. And this company's done a fantastic job of returning capital to their investors every single year. And of course, we can see the growth in their annual dividend from 57 cents per share back in 2010 to all the way up to $1.32 throughout 2021. So it's more than doubled over the last 10 years. And what's really impressive is that in the 2020 fiscal year, they did pay out their dividend, which is represented in blue, but they actually returned more capital to their investors through the form of share buybacks more than the dividend. So if you own this company, not only are you going to collect that nice 2.5% dividend, the long-term share price appreciation, plus they do a great job of returning excess capital back to their investors by purchasing their own shares off the public market. And we can see that the company's 2.5% yield only makes up 27% of their total net income, so a very low, extremely sustainable payout ratio, and they grow that dividend averaging 8% per year, and this is a dividend aristocrat with a 38-year streak of consecutive dividend growth. And like we've seen for all companies in this video, they have a 99 dividend safety score, the highest rating possible, and last year alone, they grew that annual dividend by 18%. So they were the 5th company that pay out extremely safe passive income to take a look at right now. With the market trading at all-time highs, it's getting harder and harder to find some solid dividend companies, and with a lot of uncertainty going forward with how fast the economy is going to recover, if we're going to see a boom and then a drop, there's really people don't know what's going to happen, and there's still a lot of uncertainty regarding the pandemic, which is still going on. Although we may think it's over and states are easing restrictions, it's still not fully out of it just yet, so hopefully over the next 6 to 12 months that will change, and we will see the overall economy continue to grow for many years in the future. So thank you for watching to the end. If you are looking for some safe dividend income on the market right now, definitely take a look and do some research into any of the 5 companies we discussed today. They include Procter Gamble, Johnson & Johnson, Merck, Nextera Energy, and of course, Aflac. All 5 companies trade with a 99 dividend safety score, indicating the highest rating possible from Simply Safe Dividends, meaning it's extremely unlikely that over the next few years, we see a dividend cut to come from any of these companies. So thank you for watching. Please hit that like button and subscribe if you haven't done so already, and I will see you in tomorrow's video.